Hey guys, it's Stan here. Today we're gonna talk about IPOs. So in this video today you will learn what IPOs are, when it's the right time for a company to go public, and also the pros and cons of IPOs. I also wanted to tease you for next week that I'm gonna talk about alternatives to IPOs. So let's get started today with IPOs. IPO stands for Initial Public Offering. That's gonna be the IPO, and I'm gonna walk you through the different phases of a company so you will understand why it makes sense to do an IPO, and I will also obviously explain you what an IPO is. So you have three main phases when it comes to company growth. First of all, it's a startup, then it becomes a growing company, and at some point it's going to be a mature company. So now let's quickly look at the different phases, and then you will see why an IPO makes sense and what is an IPO. So in the startup phase, so that's when the company just set up, the owner is usually the founder. It's the proof of concept phase. So is our product making sense? Are people buying it? This kind of stuff. Here, obviously, client acquisition and client retention, so keeping the existing client, is very important. Once the startup phase is over, you are starting to grow very fast. So that means here you have everything is checked if you want, and now it's time for the growing phase. In the growing phase, the company has still private ownership, which means that it's still going to be backed by a venture capitalist or private equity company. And these guys have a lot of money. They put a lot of money inside the company to make it grow, to make it profitable, and the goal is to become a mature company. And obviously in this phase, the company is growing a lot. And the idea of having a private ownership and the idea or the goal of a venture capitalist or a private equity fund is at some point to cash out, meaning you bought the company cheaply, and at some point when it has grown a lot, you want to do this famous IPO, because that's the moment where the venture capitalists and the private equity guys gonna make some big bucks here. So that's the name of the game. That's why they are looking for an exit strategy, and usually the exit strategy for them to exit ownership is the famous IPO. So usually IPO happens between the growth phase and the maturity phase. Okay, now let's talk about the difference before IPO and after IPO. As I just mentioned, before IPO, the company still has private ownership, for example, from a venture capitalist or private equity. And at some point, right after the IPO, the shares of the company float for the first time on a stock exchange, and the company will be publicly traded. So now every smaller investor, such as you and me, as well as all the big guys, such as pension funds like BlackRock, or big state funds like Qatar fund or Norwegian fund, for example, as well as hedge fund, can buy your shares. That's the big difference. You're going from private to public. And by the way, if you want to have a deeper look at the different stages of a company, and especially when it comes to financial metrics, you can imagine that the financial metrics you are looking at in the different phases are not the same. I made an entire video about it. I'm going to link it here and in the description below, so make sure to check it out if you are interested in financial metrics for the different stages. Okay, so now that we have understood when an IPO can happen, let's see how it happens. How does an IPO work? So actually you have three partners here. First of all, you have a company, then you have an investment bank, and then you have some public investors. Now let's see how they play together. Obviously, as to do an IPO as a company, you cannot do it by yourself. You cannot say, hey, I'm this company, do you want to buy my shares? I'm gonna be listed soon. That's not how it works. You know, it's a fairly complicated legal financial process that needs a lot of paperwork, that needs a lot of marketing. So now let's see how it works. So as a company, this company, they want to go public, right? So they want to do an IPO, an initial public offering. So they need to find what is called an underwriter. An underwriter is usually an investment bank, and usually the bigger name of an investment bank you have, let's say if you pay Goldman Sachs or JP Morgan, the better are your chances to have a successful IPO. So what does an investment bank do in an initial public offering? Well, the underwriter, so the investment bank is the underwriter, they lead the IPO. What does it mean? Well, it means basically they do everything from the moment they have been chosen to be the underwriter to the IPO itself, meaning the shares being floated at a stock exchange for the first time. So as you can see, there are a few steps. First of all, the investment bank will do a due diligence of this company. What is the due diligence? They are looking at everything from an operational point of view to a legal point of view to a financial point of view, and they will make a big report where they say, well, this company does this, and these are the financial numbers we have tested, and these are the legal risks maybe, and opportunities and chances and things like that. And obviously, as the investment bank is working for the company, their goal here is to draw a nice picture of the company and to make it tasty for investors, meaning juicy returns in the future. That's the goal here. Then obviously, as I said, it's big legal process, so there's a lot of document preparation involved here. That's why you cannot do it alone, because you need some very fancy lawyers, and it's kind of complicated. Then there is the SEC filing. SEC stands for Securities and Exchange Commission in the United States. In another country it would be similar to the SEC. And SEC is basically the police of the financial world, the police of the stock exchange, if you want. So that's a very important step, because obviously you need the green light of the SEC to go on and do the IPO. Then, as I just mentioned, there is also a huge marketing point, because you need to make it tasty for investors, and you somehow have to hire a pro, and investment bank is a pro when it comes to IPOs, to make your company look the best possible in the situation here. And then there is the last step is definitely the issuance, meaning they will take care of this last step of going public, meaning that they will take your shares from being private to go public. And their goal here, so to achieve all that, the investment bank will do a roadshow to public investors, meaning they will tell their best clients, usually in the first place, they will tell them, so all the big asset managers like BlackRock, big pension funds, sovereign state funds like the Norwegian or Qatari funds, all the big players in the game, they will tell them, okay, listen, we have a new company coming up, pretty interesting what they have. That's exactly what happened with Uber. I think it was last year, 2019, when they went public. So obviously everybody at this stage, if you are already a famous company, everybody knows you, but they want to know every detail and the future opportunities to see if it makes sense to invest in this business or not. So these guys will have the chance to invest. And what is happening during the roadshow is here there's going to be a bargaining about the volume of the shares, how many shares which each one take, and at what price. So here there's going to be a bargain between both of us, and this is actually part of the problem, because an investment bank will always go to their best clients and offer them the best possible returns, meaning they will bargain but make sure that the price is interesting for their client here, because they want to make what is called a pop, which means that once the stock floats, let's say at $50, it goes up the first day, and these guys make big money the first day if they have bought at a good price. Now that we have learned when to do an IPO and how an IPO works, let's look at a little pro and con list I've made for the IPOs. So on the pro side, you have the biggest pro definitely is, and that's the reason why companies make such an IPO, go public, is to have access to capital markets, which means they can raise more capital. Let's face it. I mean, when you are a private company, you have different funding rounds, but you do not have live access to new shareholders each time. So you can definitely, through an IPO, you can raise more capital, which could help you for future projects, pay your debts off, and these kind of things. Then, as I mentioned before, an IPO is always an exit strategy for the founders and also for the early investors. It's time for them to cash out because they are selling their shares to the public right now. And then there's also something I didn't talk about so far, is once you are a public company, you have what is called a live market capitalization, which means basically that you always know at each day how much your company is worth. You can Google, for example, market capitalization of Apple, which is a public company, and you know exactly how much the company is worth. This is not the case, obviously, when you're a private company. Now, moving on to the cons, and you will see there are some pretty big cons, which will explain the alternatives to IPOs, which are popping up right now. First of all, obviously, the price, IPO price. And that's the price you're gonna pay to the investment bank, which will work as your underwriter and do all the things I have described before. And just to give you a brief indication, an IPO price, and the fees and all these things, it's between 4 and 7% of list price, which is huge. Imagine the new company that just did the IPO will float for the first time at, let's say, a valuation of $1 billion. That means that the fees usually for this IPO will be between 40 and 70 million dollars, which is 4 to 7% of the list price. And that's a huge con because it's outrageously expensive. Then you also have a risk for lower stock price and a conflict of interest. I touched this topic quickly and previously when I was saying there is kind of a conflict of interest between the investment bank and their clients, because obviously the investment bank is getting the fees from the company, so that's one side of the conflict of interest. But on the other side, they want to sell at a good price for their client. So actually, when they are bargaining with their client, it is possible that they are offering a lower price than what they could get, because it's kind of a favor for their favorite clients. So this is definitely also a big con, because let's say, imagine they could get $100 per share, maybe they're only gonna get $90 per share, so that their favorite client has this advantage, the first time advantage, if you want. Then obviously, as you now know, it's a heavy duty process, a lot of legal stuff involved, a lot of paperwork, super heavy long-term process. Usually an IPO is prepared for, let's say, about a year in advance or something like that. So pretty heavy duty process, investors asking millions of questions, so definitely not a quick thing to do. Then, since you are now listed on a stock exchange, there are definitely stricter rules applying to your company, such as reporting deadlines, for example. And you have to inform the market each time there is something happening that could change the stock price. For example, change of a CEO, or you have developed a new vaccine, or something didn't work out, and these little things that could trigger a stock price valuation change. And then also there is attacks from hedge funds. I don't want to talk too much about it because it would be too long. It's the whole short seller topic, actually. So some people are making bad stories about you that the stock price is going down, and then they can buy your shares at a lower price. So this is definitely also something to consider. So now you also know the pros and cons of an IPO. Okay, now that we have talked about the pros and cons of going public, making an IPO, I wanted to tell you that next week, next Sunday, I will post about alternatives to IPOs which are popping up, especially because of the two cons here. It's way too expensive and usually you get a lower stock price. So next week, alternatives to IPOs, which is also a new topic, very interesting. Make sure to subscribe if you like that stuff. Make sure make sure to like my video if you like the content. Ask questions if you need. See you soon, guys. Enjoy your day, enjoy your week. See you soon, guys. Bye bye.